The markets just gave us a week of pure, absolute whiplash, and it was nothing short of historic. But this wasn't just random chaos. Oh no, this was driven by some really powerful forces that are basically recalibrating the entire financial world. So in this explainer, we're going to break down exactly what those forces are and what they're telling us about the year ahead.
Last week, this one headline sent total shockwaves through the precious metals market. You see, after a massive run-up, gold and silver saw a reversal so sharp, it was actually the steepest decline we've seen in over 40 years. We're talking about a brutal, sudden shift that caught a lot of investors completely flat-footed.
And, the sheer scale of this drop was just staggering. After hitting these record highs, gold fell 17% from its peak. But silver, which is always the more volatile of the two, plunged an incredible 36%. That is a massive wipeout of value in just a few days. So the question is, what on earth could possibly trigger a move this violent?
Well, the answer isn't really just about metals. This volatility is a symptom of a much larger story. Right now, the market is being pulled in two totally different directions by two incredibly powerful and often conflicting forces. And understanding these two drivers, that's the key to making sense of all the uncertainty we're feeling.
Okay, let's start with the first major force, which has been this constant background noise for months now. The administration's aggressive and, let's be honest, highly unpredictable trade policy. It feels less like a strategy and more like a constant fire hose of actions. What this does is it creates constant motion. Just when the market thinks it finally understands the rules of the game, a new tariff is threatened, or a deal is suddenly struck, or a negotiation is just terminated out of the blue. This makes it almost impossible for businesses to plan their supply chains or for investors to price risk with any kind of certainty. Just look at the pace over the last few months. In October, we were on the brink of 100% tariffs with China. Then, by November, a deal was struck. Then, bam! December and January brought this whole flurry of new actions, targeting everyone from Switzerland to semiconductor producers. It's a truly dizzying sequence of events. And, no major trading partner has been left untouched. We've got a tense truce with China, and talks with the EU are basically paused after nearly collapsing. And while a new deal was reached with Taiwan, negotiations with Canada were just completely terminated, followed by a new tariff. The global trade map is literally being redrawn in real time. So that's the first force, constant trade uncertainty. Now for the second one, which was really the trigger for last week's market explosion, a massive potential change in leadership at the single most powerful financial institution in the world. The Federal Reserve Chair is, you could argue, the single most powerful financial figure on the planet. Their decisions on interest rates can move trillions of dollars, and they affect everything from your mortgage to the value of the dollar and the price of stocks. And this was the news that broke last week. President Trump nominated Kevin Warsh to take over the role. Now, this wasn't just a routine personnel change. No, this signals a potentially radical shift in the Fed's entire philosophy. This signals what could be a massive pivot. You see, the current Fed under Chair Powell has been dovish, meaning focused on supporting economic growth. But the expected Warsh Fed is famously hawkish, meaning the number one focus would shift to fighting inflation, even if that means raising interest rates and slowing the economy down. It's a complete 180 in policy. The market's reaction was instant. The mere prospect of a hawkish Fed and the higher interest rates that come with it sent the US dollar soaring. A stronger dollar is like poison for commodities like gold, which are priced in dollars and don't pay any interest. So as the dollar rocketed up, metals just crashed. This triggered what are called margin calls, forcing traders who borrowed money to bet on rising prices to sell their positions immediately. And that turned a sharp sell-off into a complete rout. Okay, so we've got the tariff fire hose creating uncertainty and a new Fed chair nominee shaking up monetary policy. But what about the ground truth? Let's take a look at the actual economy that has to somehow absorb all these shocks. This is the question that every trader and investor is asking themselves right now. We've talked about all the policy noise, but are the actual economic fundamentals actually strong enough to weather the storm? Well, the data paints a very interesting and kind of conflicting picture. First, it's really important to remember that investors were riding high. 2025 was a fantastic year. The S&P 500 returned a healthy 16%, and even boring old bonds gained over 7%.
So the market entered this period of uncertainty with some really strong momentum, but that can be a double-edged sword. And here's the catch. After those big gains, stock market valuations are now, well, they're stretched. The S&P 500 is in the top 8% of its most expensive levels, historically speaking. And what that means is there's very little room for error. The market is priced for perfection at a time when things feel anything but perfect. We're even seeing this fragility in tech, which is supposed to be the market's most powerful engine. Recent earnings show a clear split. While super strong AI demand sent SanDisk soaring and Meta rallied, a giant like Microsoft actually fell after reporting slightly weaker cloud growth. This just goes to show you that even within the strongest sectors, picking winners is getting a lot harder.
And if you zoom out, the broader economic data is also pretty mixed. Inflation, the very thing a hawkish Fed would want to fight, is still stubbornly above that official 2–3% target. At the same time, a key engine of the economy, our manufacturing sector, has actually been shrinking for nearly a year. This really complicates the picture for any new Fed chair coming in.
So where does all of this leave us? We have this collision of powerful forces and an economy that's sending mixed signals. Let's pull it all together and look ahead at what you really need to be watching this week.
Okay, this is the key takeaway. It all boils down to this. On one side, you have the government's fiscal policy, things like tariffs and spending, which are unpredictable but are generally aimed at stimulating certain parts of the economy. And on the other side, you have a new central bank leadership that seems ready to be restrictive, to fight inflation by slowing things down. These two forces are on a collision course. So keep your eyes on this roadmap. This week, central bank decisions from Australia and Europe are going to give us a global read on this whole inflation fight. Then on Friday, the U.S. jobs report is going to be a crucial health check for the American economy. And finally, earnings from tech giants Alphabet and Amazon will show us if the market's biggest leaders still have that momentum.
So that's where we stand. This is where we stand. This is the Great Recalibration. The easy money might just be over, and the market is now grappling with the fundamental question for 2026. Which force is going to win out? The push of aggressive government policy or the pull of a newly hawkish Federal Reserve? The answer to that question will define the year ahead.